Shorting, or going short, is to speculate on a falling price. You can go short on most assets, including shares, commodities, indices and currencies. When you go short, you profit from a falling price and lose if the price rises, a mirror image of going long or buying an asset. Unlike with conventional shares, you can go short using CFDs. Shorting can be priceless when negative headlines arise and financial crises occur. Markets tend to overreact to bad news, and markets tend to fall faster than they rise. Think 2008, the financial crisis, the euro debt crisis, the US debt ceiling crisis. Think Egypt, Syria, Russia, Ukraine. Each of these events was accompanied by a significant stock market decline. By shorting, you can turn these events into opportunities. If you deal in conventional shares, you have little choice but to run a loss or exit the market. With CFDs, it doesn't have to be that way. Remember BP in 2010, the Macondo well disaster? In 2 months, the stock fell over 50%. Let's assume that you hear the news and decide that BP will fall. You decide to go short on £10,000 worth of BP shares. This 50% fall is a move in your favour, and in this case, nets a profit of £5,000 from your position of £10,000 worth of BP shares. Of course, had the share price risen following the news, you would have incurred a loss. Hedging is to take a position to offset all or part of another. You could go short using CFDs to offset an expected loss on a physical position you hold. For example, let's assume you hold 10,000 conventional Vodafone shares. If you decided that you thought Vodafone's share price would fall but didn't want to sell your shares, you could decide to short sell 10,000 Vodafone shares using CFDs. In this case, the loss incurred by a fall in the share price would be covered by the profits on your CFD position.